Well, what's up guys? Welcome to the Momentum Trading Lab. In today's video, I'm going to teach you one of my best performing day trading models using ICT and SMC concepts. And without any further ado, let's get into it. Okay, so this is basically what we'll be going through, some basic stuff about day trading, the framework for this trading model, how to identify the draw on liquidity, the important liquidity levels that you will need to know, how to identify the point of interest, and how to execute the trade once we retrace into the point of interest, and then how to manage the trade as well as risk management. All right, so first thing about risk management. So the positions will only be opened when all of the entry criteria has been met. Once a position has been opened, the position will strictly be managed according to the trade management plan. So basically what that means is that we will not be fiddling around with our stop loss or our TPs. We will have a predefined plan for that, and we will execute that plan accordingly. The next thing is patience. So not every day will be ideal for day trading. It is critical to be patient and wait for those high probability setups. And the next thing is to think risk first. So we have to be aware of the amount that will be lost if your stop loss gets triggered. Always follow the risk management plan. So within this training course, I will show you my stop loss management strategy as well as my risk management strategy. All right, so this is the framework for this trading model. So the first thing is we are going to identify the draw on liquidity for the day, and I will show you how to do that. And then we are going to wait for a point of interest. The next thing is once price retraces into the point of interest, we are going to make sure that our risk parameters are correct, and then we are going to execute the trade. We are also going to define the time frames that we are going to use. So the time frames will be categorized, and we won't be mindlessly flipping through different time frames. Each time frame will have its purpose. For the draw on liquidity, we will use the daily, the 4-hour and the 1-hour chart, and this is in a hierarchy. So the daily will give you a stronger draw on liquidity than the 4-hour, and the 4-hour will give you a stronger draw on liquidity than the 1-hour. The next thing is our point of interest. That will be on the 15-minute time frame. Once price action retraces into our point of interest, we are going to sort out our risk parameters. In Notion, I have a risk calculator that I built for futures trading. I will show you how to use that. And then after that, we will be going to the 2-minute time frame to execute the trade. So the draw on liquidity, this will give us our daily bias. So at the start of each trading day, the daily bias needs to be determined by establishing where price is most likely to go. So I will show you a couple of examples how to identify the draw on liquidity. It's very simple. And like I previously mentioned, we will be using the daily, the 4-hour and the 1-hour to determine the draw on liquidity for the day. And we will study the PD arrays, all the highs and lows, and let the higher time frame displacement guide the likely draw on liquidity. And if there are no clear draw on liquidity, no trades will be taken on the day. So let's go through an example of how to identify the draw on liquidity. So if we look at this price action right here, you'll see that we had this nice run up. I believe this was on the NASDAQ. You can see it reached for the buy side liquidity above this high. But you'll see that price action could not displace above this high. You'll see that it started printing these wicks in the area of the high. And that tells me that price is most likely going to go to the downside. If we cannot displace above a previous high, then we are always likely to go to the downside. So then what you can do is you can look what PD arrays do we have in this area, in the discount area. We have a fair value gap right there, and we have a bullish order block right there. Right, so you can use your Fibonacci tool and just only use the 0.5 on that to distinguish between discount and premium. So now we have identified that there are a fair value gap and an order block in discount. So the draw on liquidity will be towards this area because we have these discount PD arrays. And then you'll see price action traded straight through the fair value gap into the discount bullish order block. So that's basically how you can identify the draw on liquidity. So if we cannot displace above a previous high or low, then it's likely that price action will reverse. Okay, and then important liquidity levels that you need to know and understand. So the first one that I like to look at is the session-based liquidity pools. And this I got from the ICT One Setup for Life video. I also made a summary of that and I'll link it to the corner of this video. So basically what this is untouched highs and lows that formed in the ICT kill zones. So if they are still untouched, that will be an indication that they are resting liquidity above or below those levels. The next one is the previous day's high or low, the previous week's high or low, or the previous month's high or low. Then we also want to be looking at relative equal highs or lows, and this will be on the 1 hour time frame and up. And we'll also be looking for swing highs or swing lows on the 1 hour time frame and up. All right, so the next thing that we will be discussing is the elements of a point of interest. So the point of interest will be on the 15-minute time frame, and we want to see that price action traded into a level of liquidity or a higher time frame PD array. So level of liquidity, that refers back to these levels. So your session-based liquidity pools, for instance, a New York AM session high or low, previous day high or low, or relative equal highs on the 1 hour time frame and up, or swing highs and lows on the 1 hour time frame and up. So after price traded into the liquidity or higher time frame PD array, displacement must be visible. So if we have a look at this example, we had the structure trading into a level of liquidity. So this could have been, for instance, a London low, a New York morning session low, or a higher time frame PD array such as a 4-hour bullish order block. Then we want to see displacement in the opposite direction, and displacement equals fair value gap. So on the 15-minute time frame, you want to see that there is a fair value gap created after we traded into this level of liquidity, and we want to see this displacement leg break the market structure into a bullish market structure. So how you do that is you keep track of the very last lower high, and as soon as we take that out with displacement from a level of liquidity, that will be a valid bullish market structure shift. All right, so now that we had these conditions met, traded into liquidity, displacement into a market structure shift, then we want to observe the discount and the premium area. So you can pull your Fibonacci from the low to the high, and everything that is below the 0.5 or the equilibrium is considered discount. So you want to be aware of all of the PD arrays on the 15-minute in the discount area. So if we have a look at this example, we have the fair value gap. It's slightly in discount, but it's also got an area in the premium area. But if we just look a little bit lower, you have this bullish order block right here. So we can target this order block as our PD array in the discount area. But this is just a little bit zoomed in with the order block marked off. As you can see, it's in the discount area. So this will be our point of interest on the 15-minute. So now it's just marked blue. So we will be waiting for price action to retrace into this level, this 15-minute bullish order block. Okay, so I added this in here as well. This is slightly outside of the scope of this tutorial, but you can use the OTE, so the area between the 62% retracement and the 79% retracement. I also like targeting the PD arrays in that OTE area. All right, so we are going to stay on the 15-minute time frame until price action retraces into our 15-minute point of interest, and we will only be taking a trade if we are in a ICT kill zone. So for London, that will be between 2 and 5 a.m. New York Eastern Standard Time. And then we have the New York morning session kill zone, which is from 8:30 until 11 a.m. And the New York afternoon kill zone from 1:30 p.m. up until 4 p.m. Right, so price trades into our point of interest. Now we can switch to the 2-minute time frame. So this example now is on the 2-minute time frame, and we want to observe the market structure. So as you can see, we have a series of lower highs. So we want to keep track of the very last lower high. And if we can take out that high with displacement, that will be a bullish market structure shift. Right, so now we traded into our point of interest, which was that 15-minute bullish order block. We displaced away. We had the bullish market structure shift. And as you can see, we had the fair value gaps. So displacement equals fair value gap. So we want to see a fair value gap there, even though we might not target that for our entry. It needs to be there for the valid displacement. All right, so now that we got the displacement, we will pull our Fibonacci and we will observe the discount PD arrays. So right there, we have a little fair value gap. And also we have a bullish breaker block right there. So for the example, I'm just going to use the fair value gap. So now that we've identified where we want to enter the trade, if price action on the 2-minute time frame retraces back into this fair value gap, we can enter right there with our stop loss below the low. But at this point, we need to start thinking about our risk. So before we place any orders in this fair value gap, we need to determine our position size. So let me quickly show you how I do that. So I created a futures risk calculator. Okay, you can find this calculator in the Discord. All right, so let's say I have a $50,000 account and I am risking 1% according to my risk strategy, risking 1% per trade. I want to trade the NASDAQ, and let's say I have a stop loss value of 10 points. So from entry to stop loss is 10 points. Then you enter your stop loss value and you click calculate. Then the calculator will tell you that you can enter with 2 NQ contracts, and if the trade goes wrong, we will only lose $400. So now I know that I can enter this trade with 2 contracts. All right, so now you can come back to the chart and you can put your limit order right there for your 2 contracts and then wait for price action to retrace back into this level. And then once price has traded into this level and tripped you into the trade, then we will move back to the 15-minute time frame. All right, then you'll see this is the structure that we originally observed on the 15-minute time frame. We've now entered around there and switched back to the 15-minute time frame. So we are going to do this so that we can set up our take profits. And the take profit strategy is that the first take profit will be at that high. So if you pull your fib from the low to the high, first TP will be right there. So you can start scaling out right there. Your second take profit will be on the negative 0.27 on your fib tool. So I'll show you this in a moment. Take profit number 3 will be at the negative 0.62. And take profit number 4 will be at the 1 symmetrical swing of this impulse move. So to manage your stop loss, once take profit 1 has been reached, which is this level over here, reduce your risk by 50%. So now you move up your stop loss to 50%, which will be right about there in this example. Once we reach take profit 2, move your stop loss to entry. So once price action takes out this level, stop loss to your entry. Once price action has taken out take profit area number 3, which is this one right here, then you can move your stop loss into profit and protect it by a PD array. And then once price action reaches take profit level number 4, then you will be taken out of the trade, and then you will do your journaling and your review of the position. Okay, let's have a look at an example. So let's have a look at the draw on liquidity first. And I am on the 4-hour chart and I am using the S&P 500 futures contract, ES. All right, so let's have a look at what's going on. So first of all, you'll notice that price action is in this fair value gap. And then also, if we look at how price action reacted with the previous highs, you'll see we couldn't really displace above that high. We couldn't displace above that high. And we couldn't displace above that high. And now we have relative equal lows right here inside of a fair value gap. And then we have this bullish order block candle right there. All right, so to me, this clearly says that the draw on liquidity is to the downside. So we are going to have a bearish bias on this specific trading day. So let's now go to a lower time frame. Okay, so we are on the 15-minute time frame, and I marked off the New York morning session kill zone from 8:30 until 11. So we are kind of expecting to take the entry in this time window. So if we are bearish, right, so we established that the draw on liquidity is to the downside. So if we expect price action to go down, we would first expect it to go up to a raid on liquidity or rebalance an old fair value gap and then continue down. So let's have a look at the potential liquidity pools that we have right here. And like I mentioned in the slide, the levels of liquidity that we look at is the session-based liquidity pools, the previous day high or low, previous week high or low, previous month high or low, relative equal highs, relative equal lows, swing highs and swing lows. I already know that the London high was right there. So the London high is between 2 and 5 a.m. New York time. Okay, so we have the London high right there. We already started to tap into it. We already took out the Asia session liquidity from 8 o'clock until midnight. So the high has not been taken out. So we can mark that off as well. And it has been taken out. Let's just put a line there, and then the low was taken out as well. All right, and then I marked off the New York PM session high and the previous NY AM session high. So if we are bearish, expecting price to go down, we are first of all expecting it to go up to ride on liquidity or to reprice an old imbalance. All right, so let's see how this continues to play out. All right, so right at the start of the kill zone, we get displacement down. So the very last higher low was right there, and we clearly displaced past that level. So that is a bearish market structure shift with displacement. So we can start using our Fibonacci tool. Just going to quickly remove the kill zone lines. Okay, so from the high to the low, everything in this box is premium, everything in this box is discount. All right, so let's have a look at the PD arrays that we have right here. So on the 15-minute, we have that bearish order block sitting right there, and then we have these down close candles before the move up that takes out the London liquidity. So that is a bearish breaker block. All right, so now if price action moves back into this area, so this will now be our point of interest. All right, so like we said, we are just going to stay on the 15-minute time frame until price reaches up into that level, and then we will switch to the lower time frame, which will be the 2-minute, starting to go up. All right, so right there it goes up into our point of interest. Now we can go to the 2-minute time frame. All right, so like we said, we need to observe the market structure on the 2-minute time frame. And we need to identify the very last higher low. And if price action displaces past that low, that will be a bearish market structure shift. Okay, let's see how this continues to play out. Okay, there we shift past that low. Okay, now we need to look for a premium PD array on the 2-minute time frame. So let's have a look. So we have this up close candle. We get a move down. Also creates a fair value gap, but this is not in premium. So what we can do is we can put our limit order on this order block. And then we'll get back to the TPs in a moment. All right, so now we need to look at our stop loss value. So the stop loss value is 5.75 points, so 5 points and 3 ticks, just above the high. Let's make it 6 points. So now we go back to the risk calculator. Okay, and we are going to trade ES. The stop loss value is 6 points. We are risking 1%. We calculate. It tells us that we can enter with one contract to lose $300. So this is just because of the multiplier. So if we go to the micros and so calculate again, then we can use 16 contracts to lose 480. So I'll enter this with 16 micros. Let's see how this plays out. And the other thing is it needs to be within the kill zone. So let's put a line at 11 o'clock and one at 8:30. Okay, right there tags you into the trade. So at this point we are in the trade. Now we can go back to the, let's keep that there. Just going to remove this for now. All right, so now we are back on the 15-minute. I'm just going to move that to the side. All right, so using the fib that we had right here, the one that we use to establish if there's a PD array in premium, we can use this one. Then you can add the negative 0.27, the negative 0.26, and the negative 1, which will be one symmetrical swing. Our first take profit will be right there. Then the second one will be, let me actually switch on the levels. Okay, so our first TP will be at this level right there. Second one at the negative 0.27. Third TP at the negative 0.26. And then one at the full symmetrical swing. All right, with our stop loss right there. Just going to put a line there so we can verify that it doesn't hit that level before it comes to our TPs. All right, so now you just sit back and let it either go and hit your stop loss or your TPs. You can see it went straight to that negative 27, the negative 62 and the negative 1 right there. And you are out of the trade with decent profit. That would have been the last TP, about 40 points on ES. And that's pretty good.